Hello everyone, welcome back to Take Technical Trade Sync. This is the second video that we'll be posting in regards to the financial statements with a series of videos that will showcase to everybody about how myself and Cole look at the markets before we make our decisions. The videos might make it seem like we take a long time, but realistically we're just doing this so that everybody can see in details how we do things and break it down so it's easier to make small, shorter videos as opposed to one massive video. Attention span of everybody isn't, as bearing. So, without further ado, we're going to continue with the income statement and then make our way to statement of cash flows. I found that within this video condensing both, it's easy just because these two statements are the easiest to, in my opinion, assess because it's super self-explanatory just by the way the line items are presented. But yes, so now with the one that I have presented to you on the screen here, it's the income statement and it's in millions, keep in mind again. So again, 4 million, 64 million, etc., etc. I've spoken on this last video. The idea about income statement is it provides people like yourself and me with a company's revenue, gains, expenses, and losses over a specific period of time. This will allow you to see how companies performing and what their net income are on those exact metrics. So looking at it, we have beginning with net sales. Net sales, of course, is what Apple sold for their products and services. Products would be like the iPhone 15 and any other iPhones, and services would be Apple Care that you pay for example, or different kinds of services that you have like Apple TV, etc., etc. Of course, you're going to see products go up a lot higher in comparison to services. Now you see that in as of June 29, 2024, to comparing it to the previous year, July 1st, 2023, this is a little bit different in comparison when we looked at balance sheet, which was about the year ended. I find that the income statement, it shows exactly in that timeline from this year to previous year how a company is doing. And it's up quite, decently and healthy, as I mentioned before in the previous video. Cost of sales are just going to be products and services. So products would be the cost of producing the iPhone, and services would be the cost of paying an employee to fix your iPhone for the Apple Care because you damaged it. That's just an example. So when you look at the two, you see that your total cost of sales and your total net sales give you a gross margin of 39 billion. So obviously they're doing well, and Apple doesn't have their cost of sales is arbitrarily way too high in comparison to net sales. Anyways, moving forward, we have operating expenses, research and development. That is essentially just going to be adding in AI to the new iPhone 16. That's research and development. Selling, general, and administrative. These are all non-production expenses. So they're incurred by a company in any given period. This includes advertising, marketing, accounting, etc. So all the expenses that are contrary to research and development are presented here below, which gives you a total operating expenses of 14 billion. Now, the sum being the subtraction, my apologies, of total net sales and cost of sales gave us a gross margin of 39 billion. If you do the math and subtract those two, total operating expenses being 14.3 billion, you subtract the 39 billion and 14 billion here, you get 25 billion in operating income. This is just other. It could be anything. Again, just a small little figure of 142 million in comparison to the 25 billion. You add those up, and then you take into account the income taxes, and you're left with a net income of 21.4 billion, which was this last June. In comparison to July 1st, 2023, where you had 19 billion. So again, with a very well-structured company like Apple, they're performing well. Earnings per share, this is exactly just what the stockholder of or shareholder of Apple common shares, which means you and I, one share, what we're getting out of it. So 1.40 is essentially just taking into account the net income, and you divide it by the amount of common shares, which is the 15.2 billion right here. Multiply that by 1,000, you'll get 1.40. So again, take this divided by 15.2 billion, whatever number you get, which will be the 0.00014, multiply that by 1,000 and you get 1.40. That value has gone up as comparison to last year, so your earnings per share of owning Apple are 1.40. Diluted is essentially just used as a performance metric. It assesses a company's earnings per share if all convertible securities are exercised. So exactly, you mean being selling and exercising your position on Apple, what you would get. It's never too far off. Usually people look at basic earnings per share, so keep that in mind. With Apple, they've also just reported their net sales by region being different parts of the world based off of continent or areas where their sales are the strongest, and so on and so forth. And you can look at that yourself. I'm not going to get into too much of that. Or also just the net sales by category. And obviously, who would have thought iPhone would beat a Mac by such a large margin? Nobody, because everybody has an iPhone, so iPhone has a big market share. Anyways, with condensing this really quickly before I go into cash flow statement, very easy to kind of look through and seeing how the company's performing. Moving forward, we have our cash flow statement. Now, with cash flow statement, it is a business cash flows. It looks into the cash aspect from its operating activities, financing activities, and investment activities. It's broken down into each section of the three that I just mentioned. So, net income, again, just income based off of their activities in operating, financing, and investment. Depreciation and amortization would just be their facilities, what they've bought, depreciating over time, the equipment that it takes to make an iPhone, etc. Just the amortization of that and the shell life of those equipment or anything really. Share-based compensation expense. This is a very wonderful thing. Exactly what it says here is that it's 8.8 billion. What it means is that is an expense that's just given to. So let me break it down. So employees or stakeholders in Apple would receive a stock or options or equity of some sort in Apple. That is what share-based compensation expense is, and it's an expense to Apple because they're giving it to, again, people or stakeholders, employees or stakeholders. Other could be anything again. Accounts receivable net, we talked about this already. Vendor non-trade receivables, I'll go into this again. Actually, I'll go into accounts receivable too. That's us being Apple here in this example. What we're expected to receive from giving our services or our product to whomever. Now, this number being down again is a good thing just because you don't want it to go up, just because then the likelihood of you receiving the money from, again, providing services or whatnot is doubtful. Now, with the vendor non-trade receivables, that's essentially just when you're Apple or somebody, you're not dealing with your regular vendors. You are outsourcing for a project or something that you need to work on as a company or as an individual. You're finding a different partner outside. So with this number going down, that just means that Apple hasn't really looked into outsourcing too much this time around in comparison to last year. And this could be in your personal life if you want to make it an example or relate. Your car breaks down, you have a mechanic that you go to usually. But now your car is broken down, but there's a specific thing your mechanic cannot do for you. So you outsource to a different mechanic, and then this mechanic will help you with your problem that you have. That's essentially what vendor non-trade receivables is. Payables would be you paying. Receivables would be, of course, just like accounts receivable, you receiving income in the form of providing a service to you being outsourced to by somebody else. Inventory is self-explanatory. Accounts payable is the opposite of receivable. You owing money for whatever service or anything in that regard. This has went down, which is a great thing. In my opinion, Apple's doing a very good job. Accounts receivable going down means you're not, owed a lot of money. Accounts payable, you don't owe too much money to other people outside of your company ventures. Investing activities, you have marketable securities. This we discussed last video. There's anything that kind of Apple can convert into their shares or anything into cash. This is proceeds from maturities of marketable securities. So it's securities that they had slated to sell due to the maturity period, the annuity period that they've set out for itself. Proceeds from sales of marketable securities. So what they've earned from selling their shares into cash. Payments for acquisition of property, plant, and equipment. Apple's expansion project in different parts of the world. That's what that is. Financing activities. Payment for taxes. This is self-explanatory. Payments for dividends and dividend equivalents. This we haven't discussed yet, but I will discuss it further in my next video. But essentially, this is just Apple giving you money for just owning their share every 3 months based off of many, many metrics, which we'll go over. Repurchases of common stock, that's us selling the shares, being common shareholders. Apple will just repurchase them just because they will then issue it to their employees or other stakeholders in the form of share-based compensation expense, as we discussed earlier. Proceeds from issuance of term debt. So you as Apple are issuing term debt to whoever. You're the issuer, so you are making money from interest. That's nothing, meaning they have none. Repayments of term debt. That's us owing term debt. It could be short-term, long-term. Short-term is a year or less. Repayments of commercial papers, already discussed last video. And cash used in financing activities. So, as I mentioned before, operating activities, investing activities, financing activities. You take all of that, the 97,000, 1.4 million, 97 billion, 1.4 billion, and 91.4 billion. You take that, and then you see your cash equivalents, restricted cash ending balance, and then you'll notice that it's in the positive 26 billion. Over here, you have cash paid for income taxes. That's just the income taxes that Apple will decide to pay. This might sound vague. I just wanted to keep it short, but again, just keep in mind with cash flow statement. It's just 3 sections: operating, investing, and financing. And if you watch and rewind the video, you will know that it comes down to just how Apple is doing on a cash basis in each of their section that you've broken down into. Now with the income statement, again, we've talked about this already. This is, again, revenue, gains, and expenses or losses over a specific period of time, and then cash flow statement I've already explained. Overall, with the financial statements, I've assessed it very quickly, but I just wanted to highlight that this company is very healthy. I only really highlighted the line items that I figured might not make sense, or give an example to personal life of things that may or may not, be of substance. My next video is going to talk about asset allocation model, which now we will cover on the third video again. This will be highlighting how you can break down different sectors and different industries. I just wanted to highlight financial statements again so that people can see that it's important to take a look at them. I will see you in my next video. Have a great rest of your day, a couple days, and we will chat soon.